Hey all, Choboy here. We're going to be talking about diversification of investments today. So we're going to be talking through the slides first, then I'm going to be talking about how you can apply this in Sharesies, for example, for funds and companies, and I can give you more examples beyond just shares and funds, and also some other examples on the way. So let's get into it real quick. What is diversification? Well, diversification is spreading your portfolios across multiple investments. Now, this can work in a few layers, and the top layer, in the high level, you can have it in either, for example, properties. I have the example here, properties. You can have some shares, and you can have some funds, some other things like bonds, maybe even cryptocurrencies. So putting them all together, and that makes your total portfolio, right? I mean, you have lots of different things, and even within each investment type, like for example property and stuff like that, you might have an apartment, you might have a house or a townhouse or a unit, whatever. And for shares, you can have a lot of different companies in it, and for funds you can have a lot of different funds in it. Cryptocurrency goes the same way. You can have global bonds, New Zealand bonds, and stuff like that. There's so many ways to diversify, yet people don't do it that well. And I I'm here to change that a bit, right? So this can apply within a single or multiple investment types, as I just mentioned. It's really, really easy. The concept is so easy. The problem is choosing them, right? Not going to be talking about, which ones you should look into, which one I kind of recommend, because I'm not a financial advisor. Once again, I will talk about them maybe in the future, but for now, I'm gonna just, you know, step back from that, and we're gonna be going through the basics. Now, you can do this, and for example, a lot of people who have a decent amount of capital would, buy some property, buy some shares, buy some funds, and they'll leave it, right? And just chuck in more money as it goes, especially in the shares and funds. It's easier to chuck in money into those than rather than properties, right? Because properties, you've got to buy a whole new property, and it's not a easy job, right? Need a bit of deposit and some negotiating with brokers or something like that, and mortgage providers. There's a lot of work involved with property, so therefore, property does yield better money, I guess, if you buy the right ones for a decent price and all that. So there's a lot of ways to make money, but the important thing here is you need to diversify as much as you can so you get the best of each market. Now, why do people diversify? Why do it? Well, first of all, you minimize risk. For example, let's say the property market's going down, but you still got the shares and the funds market, and they're working pretty well. Your overall investment is not tanking because you got some balance here and there. And for example, this works even well even within a single investment type, where for example shares, right, like companies, they're not all tied up together. If some companies are doing really bad, there might be companies that are just flatlining or going up at the same time, where it kind of balances out. So you're minimizing the risk of going into just one type of investment. Now, that does obviously minimize risk because you're not banking on one thing. It does normally yield a lower but consistent annual return. Most people who go for the long term, they have a rough, like let's say they do like ETFs and stuff like that, they're roughly looking at 7.5 annual over the long term. So every year per annum, you're getting 7.5%. This is probably account for all the positive and negative years. For example, good years like last year and stuff like that, the funds and shares, they've been doing like pretty good, like 20 to 40% plus. I mean, it's crazy. It was a crazy year, and that's what you're banking it on. On the negative years, you'll go negative, but in the long run, you're getting a really, really good, consistent return if you look at it per average annum. Exposure to more markets. Now, markets are pretty interesting. So, for example, this kind of means different investment types. Property does have its own pros and cons. Same with shares, same with ETFs. Now, for funds, for example, you got funds like the new ones like emerging markets and stuff like that, healthcare innovation, robotics fund. You got a lot of funds, and these are pretty interesting. If you want a piece of that, that's a bit high risk, but if it works out well for that industry or that sector, then you're getting the money for it. And because you're splitting up your whole portfolio in different investment types, you get to cover a lot of different markets, and that's a really good thing for the long term, because generally, if as long as it's not a really shit market, the market trend is always going up in the long term. So for example, property, S&P 500, they're all uptrend generally. And if you're holding for that long, then for more than a decade even, then you're doing yourself a lot of good already. So that's pretty good. You're just riding the market for most cases. There are people who are trying to beat the market and stuff like that, but it's not that easy sometimes. Normally passive, like that's why they say ETF funds tend to do better in the long term, because managed funds, it's quite complicated. There's a lot of perspective going into it as well. So not sure if I recommend that, but that is something as well. And you can always, for example, if you're not fully on managed and you don't feel that too much, but you still want to be part of it, you can go 50 managed funds and 50 ETFs, right? I mean, that's totally fine as well, and that's totally viable, and that's the way to go if you think you're willing to take the risk, but not the full risk of going full 100% managed funds. And yeah, as I touched, better for the long term. You're doing yourself a lot better for the long term. It's a bit more consistent, and just the more money you have in your portfolio, just the better it is. Banks don't really give you the returns you need. That's why people invest. And you're also helping the companies in the market as well by investing. So it works. It's a win-win situation here. I think it's a really good thing to do, and it's definitely good for your long term. A lot of people who hold their wealth, they hold it in some kind of shares or something like that. You see all these billionaires and some of that. A lot of them don't have like all of them in cash, to be honest. Most of them in like some kind of investments like property or shares or something like that. So it kind of tells you something. And you can even diversify between low, medium, and high risk investments. Like for example, as I said, there are more, track record, safe, consistent funds. For example, you got like the S&P 500. These ones been performing pretty well over the past few decades for a very long time. These got good track record, so it's a bit more safer to go on those ones. Where, for example, you're going into the if you want a piece of the new ones, like the emerging markets one or something like that. Those are a bit more high risk because there is no track record of it. It's relatively new. It's a new sector and it's a new field. So it needs to prove itself over the next coming years and next coming decades. Now, if you want to be part of the early adopters of those funds and of the sector, then you're going to be rewarded if you come into it a bit earlier. But you don't want to bank your whole money into it. Once again, that's the whole point, right? So you don't want to bank everything in one go. So you just put a bit of it, like maybe like 10%, 20% of your whole portfolio in those riskier, high return potentially kind of investments. So we're going to go into how we're going to do it, which will kind of cover that. So how to do it, it's a bit wordy, sorry about that, but hopefully you follow with me. Do some research on the investments you are interested in. That's the first thing. What kind of markets you want to go into, what kind of investment types you're interested in, like property. Do you have enough for a deposit? Do you have some shares you want to buy? You're interested in a single sector like healthcare or tech or finance, business, e-commerce, whatever. What are you interested in? And find out those kind of markets you're really interested in. How you would like to split your investments between the low, medium, and high risk investments. Like for example, a common one would be like 70%, 20%, and 10% for a low, medium, and high. Now, normally you would bank a lot of it in the low risk. It doesn't necessarily mean like really low returns, but generally yes, it would be lower returns potentially. but it's a bit more consistent, low risk. It's a bit more, consistently rising. So it's a pretty low annual return, but you're gonna get it in the long term. Whereas, for example, like medium and high risk, you don't know what's gonna happen. It might tank 50% in the next day. You just don't know. And in the next day at the same time, it might pump 50%. Like, that's the whole fun of low, why do I keep saying low? So medium and high risk investments. So that's something you need to figure out. How risk adverse are you? How much risk are you willing to take? And using that, you get to make a decision to how you're going to split up your portfolio. So fun fact here, dollar cost averaging versus lump sum. Now, I think dollar cost averaging only works really if you have constant paychecks coming into your bank that you can get money out of and chuck in every week or something like that. That's a good way to invest. But if you're looking for good returns in the long term, and if you have a lot of money sitting in the bank already, I think it's worth actually having a think about putting most of it into investments earlier on. The fun fact here is that market moves in an uptrend sine wave. So it kind of moves like that, right? So what I mean by that is that there are going to be dips. It's going to be a roller coaster ride, but the general trend is going upwards, right? So that's what I mean by a uptrend sine wave. It's not really a perfect sine wave, but you get the point. It's the up and downs, short-term up and downs, but in the long term, it's going upwards, right? So I'll show you an example of that. It's a very common thing to see in S&P 500 for the past few decades. To be honest, it's a crazy one. People don't really look at historic data sometimes, but it's really important to just see how the market actually been tracking so far. It gives you a better idea. So it might be better to lump sum it if you have the money to. So let's give you an example of the S&P 500 and some Sharesies as well, and how you would diversify in Sharesies as well. So the S&P 500 looks like this. Now, the thing here is that if let's go to the earlier days, like let's look into the 1950s, it's a constant up and down. That's what I'm trying to tell you, right? It's constant up and down. It's actually, if you look at it like this, it kind of looks like short term, but these are pretty long term. Like this is 1950 and this is 1960, right? So you got a few ups and down here and there for a few years, a few negative years, like what you can see here. 1956 to 1958, it was a relative downtrend, then it's an uptrend, downtrend, uptrend, downtrend, uptrend, downtrend. It goes on like that, and that's how the market reacts. It's a very common thing to see, but you can see the general trend. What you see here, the general trend is going upwards, right? It's not sideways, not downwards, it's upwards. And this is looking at the past, I don't know, 25 years here. That's 25 years, but look how much it grew. It was like 1650 for S&P 500. Then by the end of this, it was like 95. That's a lot. That's a lot. But look at this, it's astronomical. Look at that, it just shoot off. You got the uptrend. Look at the short term, there's crazy volatility sometimes, but you look at the long term, oh my goodness. Look at the dot-com bubble. See, look what happened in the mid to late 90s. It just went crazy. See, it started at 450-ish and it finished off at 1520. That's crazy, but you get the whole idea. So in that kind of aspect, it might have been better for you to just buy everything for $100,000 here and just ride the whole thing for like the next few decades, rather than dollar cost averaging it the whole way. Dollar cost averaging only really works if you don't have the money right now, I think. If you don't have money to just put in lump sum, then dollar cost averaging works out fine. The returns are relatively pretty similar to a lump sum played on. It really depends on the timing for the lump sum, right? Timing is a big thing here. For example, you don't want to lump sum it here because at this point it's going to drop, right? I mean, you don't know that, but if the price has been increasing like that, then it's quite a dumb idea sometimes to just simply just drop a few hundred K on that, you know, because what, something that goes up will come down, right? That's the basics. Basic 101 is if something is going up, there will be a retracement and a correction, right? People will want to sell off their profits, and this might go on for years, and you just got to remember that. So when something's been pumping for a long time, you don't buy it. Like for example, let's say you were looking at it around this point in time, it's been dropping a bit, it could have dropped a bit more, but assuming there was some kind of support line and you can do some technical analysis, then you might want to lump sum it here. Then from there, it was a pretty good, another 4 years of gains here. Then you could have sold here again or something like that, because there's a clear resistance here, right? Because that's when the previous all-time high was. Then it dipped again. I mean, the 2008 was the US housing crisis, so it dipped again. It hit a similar support. It went actually a bit lower. The US housing crisis was pretty hard on the people, to be honest. But very fast recovery from that. You still got the standard uptrend, downtrend, the constant sine wave, just doing the roller coaster. But, in the general aspect, you're looking at a pretty good uptrend. Look at that. That's the uptrend. Let's say you were in your, let's say for my parents in their 20s, they were looking to buy some, some S&P 500 maybe. And let's say they bought it for $100,000, not $100,000, for $100 for a S&P share, and they still had it right now. That's how much? That's a 33 times their money. Doesn't seem like a lot, but that's quite a lot. That is quite a lot. Let me assure you, it's all about timing here. Just going to be showing you my Sharesies. So I've been chucking some money in constantly, I guess. I mean, been doing pretty good so far. I'm finally positive. That's a little update for you guys. I'm $53 up from my total. I mean, it's a 3.53. That's not too bad for a month and a few weeks, month and a half ish. I started in mid-January, so it's just been over a month, and that's a pretty track record. That's mainly because I bought a lot of shares in Plexure. As I said, I've been buying them, and I've been just buying them as soon as it started going up, and I was like, oh, alright, I gotta get into this, because as I said, it is my previous company, and it's a really good company. I think it's very low cap, so it's a very speculative investment, but it's been not doing much, it's been staggered, it's been just going sideways for a while, but once it pops off like that, I'm pretty interested. I mean, I just FOMO'd in. Normally I don't recommend, but I took a gamble. I mean, my diversification of investments is roughly I don't know, 50% of my investments are pretty high risk in general, so I love taking risk, and I love risking for higher returns. So I'm comfortable with that, and that's where you need to figure it out yourself. Are you comfortable with that or not? Because this might drop again, because people, it's a simple thing. As I said, if something goes up, it will come down. People will sell off once it hits a certain target goal, right? Now, see, people sold off here, then people bought again. So I'm gonna keep buying Plexure shares. I think it's a great company. It's very low cap. I'm willing to take the risk to speculate the company is gonna do a nice few times my money in the next few years. So let's see about that. This is what you don't really want to do though. For example, companies, I only have one company here. So this is my high risk investment. My entire portfolio is not just Sharesies. I got some cryptocurrencies and stuff like that as well. So generally speaking, I have a bit of property, I have a bit of shares and funds, and I got a bit of crypto. So my diversification is actually not too bad. My funds is my long term, and this is where most of my money goes into. As you can see, this is more than $1,000 worth of funds right now, and you know, that's at least more than double of what I have in PlexShare. And I don't plan to buy too much. You know, every now and then I'm just gonna chuck a few handy into it or something like that, but or maybe I'll sell it later. You know, I'll just play around with it for the short term, or short to medium term, but funds is gonna take me for a long term. So you know, I want to invest a bit of New Zealand top 10, some US funds, some US large growth fund, 250 large companies in US geared for high growth. That looks really potentially good. US 500 is just the Vanguard S&P 500 ETF, pretty much. The US mid cap is the 15% companies of US stock market excluded, and it focuses on medium to large companies, so it's got like that nice stableness to it, but also a bit of hint of growth into it as well. US responsible fund, you know, people are all about responsible kind of companies, you know, socially acceptable and stuff like that. So I think that was something interesting to get into, so I got some of that. Don't buy all the things I have here. Once again, not a financial advisor. Please do your own research before you buy into each fund, but that's comes back to my presentation, right? Focus on what you think it's going to do well in the future. Do the research on it, and if you're sold with it, then buy the shares and funds accordingly to it. You know, use my kind of list here as reference, but don't use it as a deciding factor. Thank you for watching today. If you like this video, give me the thumbs up. Put a comment down below what you thought of it. Any topics you want me to cover, put it down as well. Subscribe to the channel for more content like this. Bell notification, don't forget that, to be notified for my future videos. Well, till next time, I'll see you around.